Hi, Assalamualaikum warahmatullahi wabarakatuh. Today, our group will like to present to you company analysis with two company we choose, which is KL Resource and CAB Cakaran. So we actually taking 5 years to making analysis. So this is present by me, which is Muhammad Gadelan bin Rizan. Second, Izzat Kushari bin Zulkifli. And third, Muhammad Fikri Syahmi bin Kamaruzaman. Third, Muhammad Nasir bin Syahrul Nizam. And lastly, Muhammad Nuraiman bin Muhammad Syukur.
Assalamualaikum, my name is Muhammad Nasir, and today me and my groupmates will present to you about our project on this subject. And first of all, we would like to extend our sincere gratitude and appreciation to everyone who helped finish this research study. And also, we would like to express our deep gratitude to our friends, family, and especially to our lecturer, Sir Azwan, for their support, love, and patience during the challenging parts of this project. Okay, so here we will calculate some of the firm's financial position and financial performance. And for us, we picked QL Resources and CIB Cakaran, and we will be reviewing on their vertical analysis, which is their financial position and financial performance. The second one is horizontal analysis, which is their cash flow and variability or stability. And lastly is the company analysis to assess the company's survival. Alright, firstly is the background of QL Resources. QL Resources Berhad is an integrated agro-based company organization that engage in integrated livestock farming, the production of marine products, and palm oil activities to produce nourishing products from agro resources. Currently, QL Resources is the biggest manufacturer of fish meal in Malaysia, as well as Southeast Asia's biggest producer of surimi and eggs. Brands including Mushroom, Figo, Icas, Surya, and Oceania are included in their portfolio of consumer food products. And thanks to QL Resources' downstream growth in 2016, they are now operating and growing Family Mart convenience shops in Malaysia. More than just quantity and diversity of businesses, they are committed to quality. They utilize advanced technology and adhere to industry best practices in their processes. QL is mindful that as a market leader, so they have to hold themselves to higher accountability by minimizing the impacts on environment and resources. Alright, nextly is for the background of CAB Cakaran. So CAB Cakaran is one of Malaysia's leading food producers and is listed on Bursa Malaysia's main board. And through their poultry farms and other food-related companies, CIB Cakaran has been providing the nation with high-quality safe food for more than 40 years. CIB is a fully integrated poultry farming and food processing company that engage in the breeding and farming of grandparent stock, parent stock, and broilers, as well as the trading of poultry feeds and other farm consumables. Continue with the processing and manufacturing of chicken, the manufacturing and trading of further processed meat-based food products, and the operation of supermarkets, followed by the manufacturing of marine products and the operation and franchising of fast food restaurants. Their continued growth with sustainable farming is assured by high quality of animal breed, effective farm management, and use of up-to-date technology, as well as strict biosecurity to prevent disease outbreak. Their recent rapid growth is the result of the effective management of their integrated value chain, as well as expansion via acquisitions.
So we making vertical analysis for both company QL Resource and CIB Cakaran. From that, we are making analysis on financial position, which is balance sheet, and financial performance, which is profit and loss. As you can see in QL Resource, the account receivable actually decreasing. For inventory, actually fluctuate for every year, and for net effect is fluctuate as well. However, it's for decreasing a little bit. For the long term debt, it actually increasing. For and also the total common equity actually decreasing. For profit and loss, as you can see, key results are making cost of sale is decreasing every year, and gross profit is increasing, and total operating expenses, which is increasing, but actually is decreasing in 2022, decreasing in 2021, and which is making causing the operating of profit increasing every year until 2021 is making significant increasing, and lastly actually decrease is increasing the net profit. So next is CAB Cakaran. As you can see, the balance sheet and PL same as the previous one. The account receivable actually decreasing, inventory actually fluctuate, and net fixed asset is actually increasing. For total long-term debt is actually increasing, and total commodity is decreasing. For profit and loss, actually cost of sale is increasing, and and the yellow one, I afraid that it was a gross profit decreasing, and the total expenses is decreasing, operating profit and net profit also show the decreasing. For overall analysis, we choose some significant that increase in percentage for both CAB and UL resource in the term financial position. Total on debt and loan debt for both company is increasing 9.41% for K resource, and for CAB Cakaran is increasing 5.44%, which show that this both taking a lot of loan to financing their operating their finance activities. However, the key result is show that they're making really good at managing it, because of that net profit is actually increasing. However, for CAB, net profit is decreasing. So next is total common equities, both have same decreasing, however different percentage, with key result 5.39%, for CAB 9.5%, which show that both of them making a lot of dividend payment to shareholder. However, for CAB Cakaran have one more significant item in financial position, which is net fixed asset that increasing 8.55%. It shows that the CAB Cakaran is over investing at that cost, because of the net profit is just not increasing, and that make they are over investing. For financial performance, both company they have really different significant item, which is total operating expenses 2.26%, for CA resource, which is they are making some efficiency by decreasing in decreasing in workforce to make it efficient. And for operating profit, they actually increase every year because of the decreasing in cost of sale, same as decreasing in operating expenses. And it shows that is cause make the net profit increasing every year. For CAB Cakaran, they have four significant items, which is cost of sale, is increasing 6.48%. However, in making gross profit decreasing 16.52%, and it also making operating profit decreasing and net profit to decreasing every year. So as a conclusion, Result performed better in managing the asset efficiently to generate an increase in the net profit in 5 years, and was able to meet long-term debt obligation. However, CAB Cakaran could not meet the long-term debt obligation since the revenue and net profit decreased over 5 years. We show that the asset to make an operating profit could not generating enough cash. Therefore, KL Resource outperformed CAB Cakaran. That's all for me. Thank you.
Now, I will present on horizontal analysis, cash flow variability, and scalability for QR resources. As you can see here, this is the table for net cash flow for operating activities, investing activities, financing activities, and net changes in cash from 2017 to 2021 for QR resources. And the second one is this is the horizontal analysis, cash flow, variability, stability for CAB Cakaran for their net cash flow, operating activities, investing activities, financing activities, and net changes in cash from 2017 to 2021. And it's in that trend line for CAB Cakaran. So based on this analysis, this is the overall analysis. As for operating activities, in comparison between QL resources and CAB Cakar for this section, QL resources have a better performance where for the five past year, QL resources have better positive net cash flow inflow at the end of the year 2021 and indicating the company has strong demand from the customer, which is generate more sales. Second one is investing activities. For the investing activities, CAB Cakara has a better performance compared to QR resources. The reason CAB Cakara have better performance is at the end of the 5-year analysis, these companies start to spend more money on fixed asset than before, and it could be they start gaining a return from the investment they made. The third one is financial activities. In this particular section, we can conclude that QR resources have good performance compared to CAB Cakaran because the financial activity line has a more stable positive and negative volatility. When the line decreases, it shows that the company is using its cash to fulfill its financial obligation or return value to shareholders compared to CAB Cakaran. Fourth, the net changes in cash. From the table, QR resources has more positive number for the last 5 years than CAB Cakaran. QR resources line graph is volatile in a positive position more compared to CAB Cakaran, which indicates good performance for QR resources. This number represents the total amount of money a business made or lost during the reporting period. A positive net change in cash means that a company cash balance has increased over a specific period. And as for the conclusion, in conclusion, based on the overall comparative analysis, QL resources perform better in operating activities, financial activities, and have better net changes in cash. CIB Cakara has better performance in investing activities. A better investing activity cash flow is a positive sign for investor and stakeholder as it suggests that the company is making wise investment decision and deploying its capital effectively. It demonstrates the company's ability to grow its business, generate returns on investment, and create a shareholder value. Overall, QL resources have a better performance as it scored 3 out of 4 requirements, which show that this company is stable for investor. On the other hand, CAB Cakara does not perform well as it only scored 1 out of 4 requirements compared to QL resources. That's all from me.
For company analysis for QR resources or working capital to total asset, the QR resources record 0.1094, 0.1395, 0.1375, 0.1029, and 0.1205. For retained earning to total asset ratio, the company record 0.3504, 0.3859, 0.3832, 0.385, and 0.373. For EBIT to total asset ratio, the company record 0.0886, 0.0814, 0.0849, 0.0872, and 0.0976. For total equity to total liability ratio, the company recorded 1.3761, 1.3177, 1.2067, 1.0585, and 1.1116. And next week, emerging market score for KL resources record 7.15, 7.35, 7.24, 6.88, and 7.08. So the results show the positive performance for each year because the scores are in the safe zone, which means that all the results are above 5.85 and can be considered as high survival. So for CAB Cakaran Corporation, for working capital, the company record 0.0448, 6.6812, 2.0875, 2.8168, and 0.0363. For returning, the company record 0.14, 0.1429, 0.2406, 0.231, and 0.2337. For EBIT, company record 0.078, 0.0325, 0.0112, and 0.08128. For total equity to total equity ratio, the company record 0.9923, 0.8182, and 0.8179, 0.7318, and 0.725. For major market score, the Cakaran Corporation record 5.57, negative 39.04, negative 8.73, negative 13.62, negative 62.34. So the company are in the gray zone, which is moderate because the results are below 5.85. For the money show that the company is in this stress zone because below than 4.15 and can be considered as low survival. For the analysis, the working capital to total asset ratio QR resources effectiveness when using asset to generate working capital compared to CAB Cakaran Corporation. So for the retained earning to total asset ratio, QR resources showing stronger earning development and larger profit maintenance in comparison to total asset than CAB Cakaran Corporation. EBIT to total asset ratio show how efficiently QR resource generate operating income when compared to its total asset, better than CIB Cakaran Corporation. For total equity to total equity ratio, QR resources is higher than the ratio of CIB Cakaran, reflecting greater financial stability and a higher equity percentage. This improves the ability to be solvent and to overcome difficulty. For the emerging market score, score higher than 5.85 is considered to be in the safe zone. As previously demonstrated, QSSOs has an excellent level of survival in this spectrum. These organizations are much more prepared to handle the challenge of a growing industry, which increases their chance of long-term growth and profitability. So in conclusion, QR Resources is a better company compared to CB Corporation from 2017 until 2021. QR Resources had regularly surpassed CIB Cakaran Corporation in key financial parameters. According to the presented ratio, QR Resources surpassed CIB Cakaran Corporation in working capital management, the earning, operating profitability, and financial stability.
For the recommendation on QR resources, the first is to perform credit checks on new customers and require new customers to use credit cards on purchases. The second is restating the lifetime to reduce depreciation and in order to increase the net fixed assets. The third is make high prepayments and less borrowing. And lastly is to keep the debt to equity ratio below 1 in order to maintain a good common equity. For BAB Cakaran recommendation, the first is the same as QL resources, which is to perform credit checks on new customers and require new customers to use credit cards to reduce return of bad debts. The second is to ask the creditors if they can prolong the payment terms on any past due bills, or maybe employ a loan consolidation programs, or renegotiate their conditions of loans, or negotiate an early payment discount on new purchases. Next is to purchase assets that would raise both the book value per share and common equity. Then, avoid competing in price and do not underestimate the influence of pricing, and to concentrate on a profitable product mix and to raise the average order value. And next is using tactics like cost cutting, revenue building, and flexibility management. And lastly is to reducing the utilities, reducing the labor costs, reducing operating costs, and lowering prices or increasing their prices.